There's no other way to say this. Individual investors are just plain bad at investing. And frankly, I can't blame them. Investing can be one of the harder things to master because our emotions are tied to our money, and the media makes it sound like our world is falling apart by the second. Morningstar found that individual investors underperformed their benchmarks over the last 10 years by a whopping 1.7% return. Can you imagine if I said, I will sell you a CD for 4%, but because you're not a professional investor, you would only receive 2.7%. That is what is happening every day in the stock market. Let's look at the data. If you love breaking down the data with me, take your mouse and smack that subscribe button so you never miss an upload. And don't forget, we've got a cool podcast called The Market Moment with new episodes that come out every Tuesday where we discuss the latest market headlines and more. Morningstar's report came out on the 31st of July in 2023 and studied the investors' dollar-weighted returns in different asset classes versus the fund's performance in those asset classes. They found that across the board, individual investors underperformed their benchmarks, but there are several areas where individuals did better than others. I'll get to that later. It's important to note that they used investors' dollar-weighted returns, which places a larger emphasis on returns when there's more invested. For example, if someone put money into an investment in the first or the beginning of the year and never put more money into that investment, their return for this study would be the exact return of the fund that they were benchmarked to. But it gets trickier if you introduce more money in different years. If someone invested in a fund on day one and it returned 10% the first year, 10% the second year, and a negative 10% in the third year, the average return would be 2.9%. But if they invested equal amounts in each year, their dollar-weighted return would be a negative 0.4%. This is because the third year they had the most dollars invested, and thus it is weighted the heaviest for the dollar-weighted return calculation. Let's look at the first chart that Morningstar shows on the study, which shows that the overall underperformance is 168 basis points or 1.68% different across the board. That means that if someone invested in a fund that had averaged 10%, the average investor would make only 8.7% on that investment. There are areas where investors did better than others, and I believe that there are some lessons to be learned for an educated investor by reading this study and diving deeper into the data. For example, allocation funds, which are kind of like target date funds that allocate to stocks and bonds for you and rebalance for you without you having to do any of the work, had the lowest gap in returns with only 0.46% difference from their benchmark. Conversely, sector equity, which is fund focused on very specific areas of the market, had a 4.38% gap from their benchmark. What this data shows me is that the less that an investor is involved in the investment decisions and timings, it is typically better for them. Sector equity is likely to be a place where people are trying to time when they get in and when they get out. For example, if oil prices fall, an investor might buy an oil sector fund and hope to time the sell whenever oil prices rebound. This has proven to be a very difficult thing to do and is very clearly proven by the data that individual investors do a poor job of this. This is why you will often hear advisors and financial professionals say, set it and forget it. The less that an investor is involved with the timing of their investments in the market, that's typically better for them. Morningstar then provided a chart showing the 10-year returns for the biggest fund categories such as large cap growth, bond funds, and international markets. The number one result from this part of the study surprised me, but the second place is right in line with what I would have expected. The place where investors had the least disparity from their benchmark in the sectors was large cap growth. And actually, the individual investors beat their benchmark by 0.1%. This was surprising to me because large cap growth is a volatile investment to hold, and people who were invested in large cap growth in 2023 had just experienced a large drop in 2022. The second place finisher was a moderate allocation. This was not a surprise to me, except that I would have thought it would be in first place. The reason that I thought it would be in first place is because people who are invested in a moderate allocation had enough prudence before they invested to know themselves and that they shouldn't hold a riskier investment before the market sold or went down. This means they are less likely to make a change when the market sells off because they already took risk off of the table before it did. The worst performer overall from their benchmark in this category was the diversified emerging markets. The benchmark returned 1.69% over the 10-year period, and the investor returned a whopping 0%. It's been a hard period for all international investors over the last 10 years, and that is proven by this study. Before I go on, please let me know in the comments below what you think about this study. I'll leave a link in the description, and I'm curious, do you agree with my takeaways or do you disagree? Do you invest yourself or do you have someone invest for you? I think we can all agree investing is not as easy as people think it is. Now, I want to talk about what takeaways a data-driven investor should have from this study. But before I go into that, there is one chart that I found to be the most interesting chart in the entire study. That is their chart showing individual returns based on the volatility of their investment. We have all heard the term, more risk could equal more reward. This chart shows how investors fared when their investment was more volatile, or in layman's terms, was more risky. The results were very clear. The more risk that an individual took, the worse they did relative to their benchmark. And in most cases, they actually underperformed their less risky investment. That means that the less risk someone takes, they actually equaled more reward. That means that the best outcomes actually came from taking less risk. Or in other words, less risk equaled more returns on the study. This is huge. I want to input a caveat to say that allocation funds actually worked perfectly. The more risk that someone took in an allocation fund, the better returns that they received and the less gap they had from their benchmark. As you can see on the screen, in the allocation fund section, if the average investor in the lowest risk category averaged 3.77% return, which was only 0.43% behind their benchmark, and their return rises as the standard deviation rises up to 7.38% return with only a 0.27% difference from their benchmark. This is what someone would hope to see. Taking more risk actually equaled more return. However, the exact opposite was true for every other category except for non-traditional equities. The more risk that people took, the worse their returns were, and the differences from their benchmark began to widen. There's more in this study, so I will link it below, but I want to highlight a few takeaways that Morningstar noted and that I believe a data-driven investor could take away from this study. First, know your risk tolerance. If you're not willing to accept the risk of a volatile investment, yet you invest in it anyway, your long-term return will likely be worse. Digging deep into yourself to know if you're willing to accept the volatility of the investment before you invest in it is extremely important. Second, be widely diversified in your investment approach so that you don't have to make decisions between different sectors and areas of allocation. Third, automate and forget. It appears from this study like the reason that individual investors are able to succeed are by using investment tools that do the work for them instead of tinkering with the investment themselves. Finding ways to simplify investments so that you don't have to decide the timing, the allocation, the rebalance timing, and the selling of investments will be important to achieving long-term returns. And that's where I think individual investors can be bad at investing. They don't take into account their own biases, risk tolerance, and plan for the long term when they begin the investing journey. And like I said before, comment below your thoughts. And if you want to know what the worst investment is, check out this video.